Liquidity is one of the biggest topics I see put out on the internet, and 3 years ago I made a video and it's one of my most popular videos about liquidity, and 3 years later I'm revisiting this topic because of course I've had 3 years more of experience and explain to you guys the secrets I've learned about it and exactly how I implement it in the market. Now, it's a very confusing topic, whether you're trying to prevent your stop losses by being hit, whether you think you're being manipulated by the market. I'm exactly going to explain in this video how to use liquidity to your advantage and have a better understanding of liquidity in the market. So if that sounds interesting to you, I definitely advise you to watch this full video here. And yeah, I hope you guys enjoyed the video. If you do all the YouTube business, like and all that BS. And then with that being said, let's get straight into the video. So the classic style of liquidity and what we know it as is liquidity just means orders, right? It's basically orders that lay in the market, and in order for the markets to move, we need liquidity. Now that's either we need an influx of liquidity of buyers or influx of liquidity of sellers to move price in a certain direction, right? And this is a big misconception people make, but that doesn't mean that the opposite party has to be losing. It could be part of their bigger position. Right now, the market is not in terms hunting your personal stop loss or trying to manipulate you. It's simply driving to certain zones in order to fill orders. So that's the idea of what liquidity is. It's basically orders in the market. So that's something I want to clear up here. Now, the concept of liquidity on the charts, if we concentrate on my drawing here, liquidity in a whole is basically done something like this. So what we expect, the classic smart money concepts model that you've been taught in smart money concepts is you basically have a range, price manipulates that range and then continues out. Stop losses were here, you got manipulated on that low there, right? And that's where your stop loss was hit. Grab liquidity before continuing price in the other direction. But as markets develop, we can see this happen as well, where you get both sides before price continuing, and you can also just see price literally take no liquidity and just continue a beautiful little trend here and continue towards the upside. Now we have the idea of that at some point all of this liquidity that lays under these lows has to be taken out, and this is the whole smart money concepts way, which you're going to get totally confused with, and for me is not the pinnacle of what liquidity means, because the truth is that liquidity is constantly changing, right? So what do we need to understand from liquidity? Well, price has to grab liquidity before moving a certain direction. That is something known. Now, how is liquidity created? Liquidity is created from structure. Structure is what causes liquidity, because obviously at this point and at this point here on the charts, we saw that what? Price came down, made a support, and then boom, bounced up to do what? To create a structural point. So obviously an influx of buyers came in here, and again here another influx of buyers came into the charts here. So that is what's creating liquidity here. Now, the second thing that's going to create liquidity is your basic zones, right? So if you have a market and you have a major resistance and you have a major support, these zones here are basically your major structural points, right? This zone and this zone. This is creating liquidity to give you the move up, and that is creating liquidity to give you the move down, right? So it's your major structural points that are creating liquidity and giving you the opportunity to continue price in a certain move. So once we understand this about how liquidity is created through structure, all we have to do is utilize that in our own trading. So where do most people get caught out? First thing is they don't understand bias, what direction the market most makes sense go during that day. I have plenty of videos to discuss bias. The second thing is waiting for actual candle closures. If we understand that a lot of manipulation, right, of price happens inside of a range where we can see price dip out the upside, and your stops get hit, we don't really care about that, because why? We trade based off candle closures. Now, price wicking in and out of these zones, yes, it is generating liquidity, and if you don't wait for the candle closures, you might get your stop loss hit because price is generating liquidity. But if we see price wick out of the bottom of the zone, so let me just draw this here and make it clear. So let's see, we see price in a range like this, and we see today we are bullish, we expect price to go up. We see price wick from the bottom, not close, from the bottom of the range. Now this is where people get involved in sells as well, as they think it's breaking the range. Breakout traders, impulsive entry traders, which is why I always trade off closures. Now let's assume we're on a 15-minute time frame. Now when we see that wick, we know that price is now what? Created structure. Now as we see price now close above the range like this, right? That's your resistance here in the range. As we see price close above the range here, we have the confirmation that price, even if there's wicks like this grabbing liquidity from before, that closure is giving us confirmation that price is doing what it could not do before and close above. And the structure we created in the range, the wick we had to the bottom of the range grabbing liquidity, will give us the move up, because we can rely on that structure for what? We can rely on that structure to hold our trade and continue the direction that we expect for today, for the day. So essentially liquidity is becoming some form of structure that we see. Now, in very rare cases, before you guys say, oh, but Harry, you know, it can manipulate the structure. In very, very rare cases, do we see price come from an accumulation or test around a 4-hour support, your liquidity zones, right? Your liquidity zones are going to be your higher time frame support and higher time frame support and higher time frame resistance. Those are your liquidity zones, 4-hour and daily. Those are the zones. So if we see price coming from one of those zones, continuing up bullish, creating high lows and high highs, it's very rare we see price break out in a time of volume, right? Because liquidity is needed for what? Liquidity is needed for price to move with volume. So if there's no volume in the market, price has to grab liquidity in order to move. So it's very rare to see price go for a second grab, continue up, right? So let's say there was something like this. So you're basically, it's not even second, it's a third grab. So basically you would create a range like this, price would do a range, you get a nice little move like this, and you're like, okay, fine, if price can close above the range, I'm taking an entry. For it to fail again, then go. It's very rare to see that. That's an anomaly, and you can't be. And that's what I mean. Liquidity is always changing. That's an adaptation you have to make to the market, and it's why you don't have to try solve liquidity. Don't solve liquidity. Liquidity is not supposed to be solved. All you have to solve is repetition and consistency in the markets. So don't let liquidity confuse you. All you have to look for before your entries is what? Structure to be formed, right? That structure is going to be the liquidity. Look where price is coming from, right? And that's what I want you guys to understand, is that stop being fooled and thinking that liquidity is such a complicated topic. It's not a complicated topic. It is just a tool we use in our trading to give us extra confirmation that price has to reach a zone, has to go grab a liquidity from somewhere before it continues in its certain direction. Now, if we're heavily trending, it's just going to create high lows, high highs. It's going to create that structure we're talking about, and that's enough when there's high volume and we're trending. If we're in a big high time frame range, say we're in a big high time frame range, then if price is in the middle of the range, guess what? It'll have to probably go grab liquidity from the bottom of the range before it goes to the top. And when it goes to the top, has to probably grab liquidity from the top before it goes to the bottom. Now, if it fails to close outside of the range, guess what happens? If it fails to close outside the range, it's probably going to fail and then end up coming down. But if we close outside the range, create structure above, then you're just going to continue up. And that's basic price action, right? So all you're looking for on the charts is you're looking, okay, before entering the move, right? You make a little checklist, is you basically say, has my trade grabbed liquidity, right? Am I coming from a zone that is structural, that price is obviously coming from, and it makes sense to continue up? That's check. Now you're trading liquidity. Second thing is, do you have a candle closure, right? Are you not just trading based on wicks? Because you could be caught in the liquidity grab if you're just trying to trade a wick. Yes, I'm waiting for closures because I'm a patient trader. Number three is going to be, are you following a directional bias? Because most likely you're not going to get into sells if you're looking for buys on that day, and you know you should be looking for buys. Because if you get into sells, those sells could end up being what? Those could be the liquidity grab to continue the buys. So are we starting to understand how this kind of works? It's not really such a complicated topic. It's just a little plus in your trading. So what I want to do is I want to show you on the charts a little bit more. I want to go a little bit more into depth, and I want to talk to you guys, okay, fine. Once we get in the trade, do we target liquidity? No, we don't target liquidity. We target ranges. I want you guys to start thinking the market in ranges. We have one range, we leave it, we form another range, we leave it, we reverse, we form our new range that goes and eats up our old range. And I'm going to start to show you how that works, how we just market trade from range to range, and our job is to look how we can capitalize in between those ranges, right? That's it. That's the job. Well, that's my job. That's what I do. That's the way I trade, trading price action, trading range to range. That's my personal way. I don't like to overcomplicate it. I don't like to add more variables to my trading that could potentially make things fail. So I'm going to give you a quick more, a little bit more in-depth analysis on the charts here, and just show you a few examples of how we're going to put this all together. With that being said, I'm just going to pop onto the computer here and show you on the markets. So let's get there. All right, guys. So now we need to put it all together. I'm going to give you two examples here of how liquidity is used when we're taking trades. So let's take this range here, right? We can see here we have this range on the chart. and we have a resistance here and a support down here. Now, if we're obviously coming down from a bearish bias here, understanding that all week price has been respecting this resistance and continuing down, what we need to see is we need to see some form of liquidity. So liquidity grab here, continue down, liquidity grab here, continue down. Now liquidity doesn't always have to break the highest high here. It can just come to a zone, grab liquidity, you see a spike into that zone, pressure moving into that zone, and then rejection off and breaking structure. Rejection off, breaking structure, right? So the cleanest example is how people get caught out is that they don't wait for that structure, because remember, structure equals liquidity. So look at this. Let's take this example here. So obviously we know that we're looking for shorts, right? Because that was the bias here. So now we get all these early shorters come into the market. They try short the market. They think, nice liquidity grab. Price made a wick, but there's no structure. There's only bearish candles. So what do we see? Boom. Now the early shorts get into the market. Immediately they're put into drawdown. Their stops are going to be above the highs, of course. And then they're like, okay, I got lucky. And then not today, right? That's it, done. They're gone and stopped out. Now we've created structure. So for us as price action traders here, we have the confirmation that price is rejecting towards the upside. Also liquidity grab, right? So it's counted the same. We have structure that we have now established in the market here, as we can see. So all we need is something closing below that structure. The minute we get something closing below that structure, that's going to be the entry. So you look for that, boom, that's your close below structure. That's your entry. So then after that, we look for price to go tap maybe into the support from previous support down here, give you something like that. Stop can either, as I said, go here or above there, and then boom, you get that candle moving down. And now you're not caught in any liquidity grab, right? So we can see another bullish scenario here, right? Let's go take a bullish scenario. Here's your bullish scenario. So we see price coming. Let's say this is our support line here. We're expecting price to react off the support. All early buyers here are going to be caught out because there's no structure created. We have not, this is too early. We need to see nice structure created, and for a reversal, we need to see that form, right? We need to see liquidity grab as well, will give us extra confirmation. What do we see happen here? We see a liquidity grab, right? Price grabs liquidity, right? Then we close above, right? All these rejection wicks, taking it at the rejection wicks. You're buying into a rejection zone, not smart. But we get the extra confirmation of the liquidity grab. Then we close above, and then you get the continuation to your next targets, right? Realistically, your target would be here. But you see how that works? So essentially what we're doing is we're just retesting back into these zones, grabbing juice to give us the push up. So always think about it like that, is that where are we grabbing juice to give us the push up, right? And that's what you want to see. Always ask yourself before you take a trade, has price grab juice to give me the next push up? And that's simply it, man. So that's two examples there. Hope that's helped. I hope this video has helped. Let me know in the comments. Definitely leave a like if you have enjoyed it. Appreciate you staying to the end of the video. Take care, trade sharp, and hopefully catch you guys very, very soon. Peace.